Hello and welcome to this Astranti training video. Today we are walking you through the ACCA SBL pre-scene for March 2026. So what do I mean when we talk about walking you through the pre-scene? Well, I mean exactly that. Because in this video series, we've got 5 videos. And in the first 3 videos in this series, I will be taking you through the pre-scene, kind of line by line, paragraph by paragraph, kind of summarizing the content, but much more importantly, drawing out all the analysis, bringing forth kind of links to the syllabus, thinking about where may be good examinable places, wow moments, and everything that you need so that you feel confident using the pre-scene in your ACCA SBL exam. Now, in the 4th video in this series, we're going to take all the information about the pre-scene company and feed them through really kind of popular models and tools like Pestel and Porter's 5 forces and the value chain and the balanced scorecard. It's a really great video. And then in video number 5, we are going to be presenting to you the top 10 most likely issues that we think that you're going to encounter in the ACCA SBL exam. We base that really on our experience of getting thousands of students through their case studies exam, and also kind of the topics that have kind of repeatedly come up in the pre-scene, or things that we think, hey, that's quite interesting, they've included that. That's not something they would normally do. And we use that in our experience and we come up with these top 10 issues. So again, that you feel really prepared when you actually come to sit the exam. So what I'm going to do now is just scroll down a little bit. We've got the pre-scene in front of you right now. And all I'm coming down to is the content screen. I can't get it all on screen for you, but it's about 10 pages long. And we're going to be dividing this, kind of, as I said, this pre-scene analysis into 3 videos. So we are going to stop video 1 just after expenses, and then video 2 is going to be down from expenses to just before products, and then we'll be going from products to the end. Now, obviously, the last bit is where we're looking at the financial information, so lots of really good stuff there too. So that's the kind of structure of these 3 videos that we're doing. But before we begin with kind of the walkthrough of video 1, let's just step back very quickly and kind of take a look at the bigger picture, because what we're going to do in this video is look at this case. And this case is centering on Merceh. Now, for some reason in these pre-scenes, they always give these companies strange names, and they're normally kind of puns that I don't realise until we're right in the last video. But I don't think there's a pun here. It's simply Merceh. I think it's pronounced that way. Apologies if you think it's pronounced a different way. And Merceh Company is one of the 5 largest magazine publishers in the country of Darland, and it's been operating for around 60 years, and it publishes over 300 magazines across a wide range of leisure subjects, from lifestyle and sport to tech and entertainment, and it does that in both print and digital formats. So at first glance, it seems like we're dealing with a really well-established, successful media business, and it operates at scale. It's listed on the stock exchange, and it has adapted, seemingly, at least on the surface, to the digital age. But once you look more closely, this company becomes far more interesting. Now, the big question underlying this pre-scene is this: is Merceh a stable, profitable media business successfully navigating digital transformation, or is it a traditional publisher facing long-term structural pressures that haven't yet fully surfaced? So, let's begin our walkthrough with our introduction. So before we're going to get into the sector detail, we're going to really ground ourselves in exactly who we are dealing with. Now, as I briefly mentioned in the introduction, Merceh is one of the 5 largest magazine publishers in Darland, and it's been operating for 60 years, and it publishes across this kind of wide range of subjects, leisure subjects that is, in both print and digital formats. So we sound like we're dealing with a really stable company that's established and diversified and experienced. But even in these very short kind of sentences we're getting in the introduction, there are strategic signals. Now, being one of the top 5 tells us this is a large-scale operator in a concentrated market. Now, the 5 biggest publishers control half of total industry revenue. So this isn't a fragmented kind of cottage industry. It's competitive and consolidating, and 60 years of history suggests brand recognition and institutional knowledge, but it also may suggest legacy systems, entrenched processes, and potential resistance to change. And the fact that Merceh, just doesn't sound correct how I'm pronouncing that, is operating in both kind of print-based and digital formats tells us this is a business that's straddling 2 different worlds, a kind of declining traditional model and a growing but highly competitive digital one. And that's not just an operational fact, it's a strategic management challenge. So from this very first paragraph, we should already be thinking, is this a business that's successfully evolving or one managing gradual structural decline? And that tension is going to run throughout this case. Okay, so let's move into our next section, which is the sector information as I scroll down. And we're going to start off with an overview of the sector information. And in the first paragraph, we find that magazines are regularly published content, and they are aimed at specific audiences, and they are built around defined subjects and reader segments. Now, at first glance, this feels a bit like a kind of textbook definition. This is where we are here, by the way. But it's doing something important. So a magazine is described as being produced on a regular schedule and aimed at specific readers around a defined subject. So that's immediately telling us 2 strategic things. First, we've got a recurring revenue model. Regular publication creates predictable cycles of production, distribution, and subscription income. And that links directly to cash flow stability and working capital management. Now, secondly, that's our first point there. Secondly, magazines are built around niche or targeted audiences. That means differentiation and community matter. You're not selling generic information, you're actually selling relevance and identity to a defined reader group. And that becomes critical when we consider digital competition. Because if similar content is available online for free, Merceh must offer higher quality, stronger brand authority, or deeper community engagement to justify payment. It's something we've seen, in the real world over the last 15, 20 years. When I think about the newspaper industry in the UK, we've seen different approaches to protecting revenue taken by different brands. So for example, the Sunday Times and the Times, they're behind a paywall, so that means that the audiences are having to pay to use it, whereas other publications are offering their content for free. So there's different approaches to kind of protecting revenue and audiences and community in order to survive in this digital age. Then we can move on to this second paragraph, where we find that the Darland magazine market is large at $8 billion. It's moderately concentrated, where the top 5 hold kind of 50% of the markets we've already spoken about in the previous section. and that publishers may diversify into related media activities. So basically what we're getting here is the competitive landscape. So we've got our total market size. So we can see at $8 billion, it's economically significant. So for a top 5 player like Merceh, which again still doesn't sound right, does it? Obviously, it shows scale and market share really do matter. Pardon me, just looking for my mouse there. There we go. Now, we found out the top 5 publishers control around half of total market revenue, which is kind of moderate concentration, intense competition among a small number of larger players, with consolidation continuing. Now, in concentrated markets, competitive moves are visible and often become retaliated against. So pricing decisions, digital upgrades and acquisitions, they all become strategic signals. Now, we're also told that the magazine publishers also have different market interests, or different media interests, I should say, such as, if I can find it again, market research services. So what we're getting here is kind of hinting at diversification opportunities, where we can monetize content and data and audience insight beyond kind of simple magazine sales. So if you later see a requirement around growth strategy or diversification, this kind of paragraph really is laying the foundation. Okay, in the next paragraph, we kind of find out about the magazines operating on a fixed kind of publishing basis. So weekly, monthly, quarterly are the publication cycles. So really this paragraph is about cadence, and cadence drives economics. So regular publication schedules mean fixed production cycles. Content has to be produced, it has to be edited, it has to be designed, and it has to be distributed on schedule regardless of fluctuations in demand. So what we've got is operational rigidity and deadline pressure. Now, from a financial perspective, subscription and advertising income are often tied to editions, giving cash flow visibility, but also meaning performance is reviewed edition by edition. And strategically, a business built around fixed publication cycles could perhaps struggle to adapt to more fluid, real-time, digital consumption patterns. So it's really about operating leverage and structural flexibility. Okay, so in this following paragraph, we find out that most magazines are published in both digital and print-based formats, but the print demand is declining. So what we're seeing here is basically the core structural tension of the entire case. Merceh operates in a dual format model, but obviously the print market element of it is diminishing, even if it's possibly remaining significant for some time. Now what we've got here is quite a significant phrase, and that is diminishing but significant, because it tells us that this isn't a sudden collapse. It's a kind of gradual structural decline, and that is kind of strategically more complex, because businesses can drift in gradual decline without urgent transformation. So print obviously brings high fixed costs, paper, printing, distribution, and digital brings lower marginal costs but intense competition and content substitution risk. So the business is managing two very different cost structures simultaneously. Now there's also a kind of cannibalization risk, because as digital grows, it may erode print revenue faster than it actually replaces it, especially if digital subscription pricing is lower or advertising rates differ. So if you see a requirement about strategic repositioning, investment decisions, or long-term viability. It's this kind of paragraph, this kind of information that's really central. Now you can see I've put another note in the top corner of the PDF. And this is something I'm going to do kind of occasionally throughout the video, as I will bring in syllabus references and stuff at more relevant points. But here, the examiner reference is just talking about some information we get in the examiner reports. And the note I've put on here, which I know is in the top corner, but is relating to the paragraph I've just been speaking about, it said that the examiner, has consistently criticised candidates for describing industry trends without connecting them to strategic demands. So what do we mean by this? Well, if we carry on with what we're talking about with that previous paragraph, writing print is declining and digital is growing, well, that won't score you any marks in isolation. Now, a strong answer is going to explain what the transition demands of Merceh's board. So investment in platform capability, cost restructuring, subscriber retention through digital experience quality. So just describing something, that's not analysis. So if you are met with a requirement asking you to evaluate the strategic options available to Merceh as print demand declines, it's not just being asked to describe the problem, it's asking you to assess specific options with commercial judgment. So maybe you accelerate digital investment, maybe you restructure print cost base, maybe you divest underperforming print titles, maybe you acquire digital capability. Now each option needs for you to say what that involves, what it costs, what it risks, and your judgment on whether it's right for Merceh. And that would be what evaluation is, not description. And this is kind of how you kind of bring in the context of the pre-scene as well into your answer. Okay, let's scroll down a little bit more now, see if we can get a bit more space. You can see we're coming to the end of the overview section, so I'll just leave it here for a second. Okay, so this final paragraph in this first section, this kind of overview, section, is all about revenue quality. And I'll just highlight the notes that I've put on screen that's relevant to this paragraph, because I know we're getting a bit full on the screen at the moment. So they're the two notes. So as I said, this paragraph is all about revenue quality. So we find out that readers can purchase individual editions, or they can pay subscriptions. Now, subscribers are obviously recurring customers, so they're strategically valuable. Subscriptions provide predictability. They improve cash flow visibility. They reduce customer acquisition costs per edition, and they create switching barriers. But subscription models create expectations. So if content quality declines or publication is disrupted, then churn risk increases. Now, in digital context, the strength of the platform experience directly influences subscriber retention. So when we later come to examine the KPIs like subscriber numbers and the revenue mix, this distinction becomes critical. So not all readers are equal from a strategic perspective. Okay, but before we move on, let's actually crystallize what we've learned from the sector. And I've just tried to fit in here very tightly three kind of key takeaways from this first overview section. I'm actually moved that when we scroll down to products to give me a bit more room for products, but here it is for the moment. But when you look at it on your PDF later on, it might be in a slightly different place. So what have we learned from the sector overview? Firstly, number one, this is a large and economically significant industry, around 8 billion in revenue with moderate concentration. Now, the top 5 players control around half the market, so this is competitive, but it's not fragmented. Strategic moves by major players will matter. Number two, the industry is managing a structural transition. Print demand is steadily declining, and that creates long-term strategic tension. Businesses must manage legacy cost structures whilst building digital capability, and the gradual nature of that decline is itself a strategic risk. It reduces urgency. And thirdly, the revenue model relies heavily on recurring relationships through subscriptions. And obviously we found out that provides stability, but also it makes retention and content quality and platform experience really important. So subscriber churn increases, revenue predictability quickly deteriorates. So already, before we've even examined Merceh specifically, which we're going to come onto in video 2, we can see the environment it operates in, a kind of competitive, transitioning industry with increasing dependence on digital monetization. So there we go, that's the overview to the sector, and this is kind of how these videos work. You can see we really do go through it. Now, how much room do we have by products for me to get my notes on? Yeah, maybe we can actually fit it all in. So I'm going to try and get all the products on screen for us. I think we're getting on to page 3 for the final little bit of products. So let's see what we can fit on here. Okay, so in our first products paragraph, we find about the kind of different areas of magazines. So really this paragraph is about demand drivers, and we can see the majority of magazines in Darland, which I don't know if I've actually kind of specified. Darland is the country in which we are operating, or the case I should say is operating. So the majority of magazines relate to leisure, so lifestyle, sport, hobbies, entertainment, etc. And with that, demand is largely discretionary. So in economic downturns, obviously the first thing to be cut normally is leisure spending. And so straight away, we also need to be aware of thinking about revenue sensitivity to consumer confidence. But by contrast, business and professional magazines serve more functional needs. So the demands could be more stable and less price sensitive. So the product mix matters strategically. So a publisher heavily weighted towards leisure content may experience more volatility, and we can see the Merceh publishes across a wide range of leisure subjects. And so what we're seeing here is a kind of exposure. Now, product mix also impacts on advertising. Leisure titles are going to be attracting consumer brands. Professional titles are going to be attracting B2B advertisers with kind of different pricing structures. Okay, then we come down to, it gets all very squeezed, isn't it? Sorry, I also lose my marker as well. Now, I know you can see this a lot better on playback and I can actually see it when I'm making it. So if I say I'm losing my mark, I don't think I'm going mad. It's much harder for me to see. But anyway, we are on this paragraph, as I've located my marker now. And basically what we find out about in this paragraph is about really what readers are kind of paying for. So it might be the latest news, for example, or topics of interest. Now, what we see really is that news is increasingly commoditized. Much is freely available online. And if a magazine is relying heavily on generic news reporting, it could struggle to justify subscription fees. But opinion pieces by recognized authors and specialist reviews create differentiation. Now, product reviews in particular often influence purchasing decisions, and that's attractive to kind of advertisers and makes it commercially valuable. But one thing we should flag is that there is a kind of reputational risk embedded in this paragraph, because let's say, for example, that reviews are biased or inaccurate, then obviously the trust with the audience declines, and trust is central to subscription retention. So content quality and credibility are not just editorial concerns, they are core revenue drivers. And it's really worth flagging the regulatory dimension. I'm going to cover this fully in video 2, but publishing inaccurate or misleading material has legal and regulatory consequences that go directly to the board's risk agenda. Okay, I'm just going to scroll down now so we get a little bit more space. Okay, so we're just dealing with this kind of line here of the paragraph. just down to this section here. I'm just highlighting the entire 2 lines just to make it a little bit easy for us to differentiate what I'm talking about one big time. So just relating to the highlighted element of the paragraph, because what we're seeing here is the introduction of digital capability differentiation. So we find out that some publishers simply replicate print content online, low transformation, defending existing subscribers, but not attracting new digital native audiences. And others are providing enhanced digital content, so additional material, multimedia, broader kind of channel engagement, representing kind of deeper digital integration and potentially stronger audience engagement. And the kind of the annotation I've actually dropped down here, so I'm going to do a little line just so we don't lose that. And really the question I'm asking here is, well, actually, so where does Merceh sit on this spectrum? If it's merely replicating print online, then that is suggesting limited digital maturity. So really what this paragraph is doing is laying the foundation for later evaluation of digital capability and platform adequacy. Okay, and then we come to the remainder of that paragraph and this kind of list down here. We've got a tiny bit of products left on the next page. And really what we're finding out here is basically that some publishers offer extra content through a number of online channels. Then we get the list. And basically this list is effectively describing a digital ecosystem. So we've got email newsletters, which are really kind of powerful retention tools because they're maintaining regular contact and reducing reliance on search engines or social media algorithms. We've also got podcasts, because podcasts extend the brand into audio and streaming formats, and that opens up sponsorship and advertising revenue streams. And then of course we do also have social media as well at the bottom there. Now that's both promotional and relational because it drives traffic but creates dependence on external platforms whose algorithms can quickly change, which is a strategic vulnerability. So what we can see here is that digital publishing is not just simply about pushing magazines online. It's about building a kind of integrated multi-channel platform. And then the strategic question that we're going to be asking later on is Merceh operating at this level, or is it actually just doing the minimum to remain digitally present? So there we go. There's our multi-channel ecosystem. Let's go down now to the end of product. And we can see the last paragraph is about partnerships. And basically, when we're talking about partnerships, I think what we're also really talking about is control versus reach. Now, they use an example of a partnership for distribution of digital content. An example they use is digital app stores. So obviously what we're seeing with this example is an expansion of distribution, and it also increases subscriber acquisition potential, but it introduces dependence. The publisher becomes subject to platform fees, terms of service, algorithm changes, and ranking visibility decisions. And that really affects pricing power and margin. And there's also things like data ownership to consider. Who owns the customer relationship? The publisher or the platform? And this also sets up potential exam angles around platform risk or bargaining power or vertical integration versus partnership and revenue leakage through commission fees. But there we go. That is the end of the kind of industry sector. Remember, we're not focusing, well, we are, but the pre-scene at the moment isn't focusing on Merceh. It is focusing simply on the industry as a whole, which is why we're kind of asking questions. Where's Merceh sitting on this spectrum, for example? But before we move on from products, let's have a kind of a mini takeaway before we move on to magazine staff. especially as we have the room for it for once. So I've got 3 takeaways on screen. So the value proposition, I would suggest, depends heavily on credibility, opinion, and specialist content, not generic news. Trust and differentiation are driving subscription retention and advertising value. Digital capability varies significantly across publishers. Some replicate print, others build multi-channel ecosystems. So the key strategic issue is not just what content is produced, but how it is delivered, how it is enhanced, how is it monetized in a increasingly digital environment. And that kind of question is going to sit underneath much of our later analysis of Merceh itself. Okay, so that is products. Let's go down now to see. Well, I don't think we'll get it all on screen, but let's just see. No, we won't. Okay, so let's just stick first of all with the magazine staff and the magazine authors, and then we'll scroll down to get all the kind of other magazine staff on screen. Okay, so let's deal with the magazine staff and magazine authors to begin with, because we can see that actually magazine staff work across I've lost my mark again, a number of different magazines. And we can also see that they use employees, so the in-house authors, and authors are kind of the writers, and also freelance authors. So we've got a mix. We've got a mix of in-house and freelance authors. Now this is strategically important because the in-house authors are kind of providing stability and institutional knowledge, whereas the freelance authors are kind of providing them with flexibility, because the publishers are only paying for output that is produced. Now that variable cost flexibility is particularly valuable in industries facing declining demand or fluctuating advertising revenue. But what we can also see, if there's a kind of reliance on freelance authors, then the kind of concept of risk is introduced, because well-known experts may demand high fees, and then if key freelancers leave, perhaps content quality or brand credibility could suffer. And there's also kind of reputational exposure, because if prominent authors maybe become controversial or produce inaccurate content, then it's going to be the publisher who bears the consequence. So really it's about balancing cost structure against control and quality consistency. Okay. Let's, as I said, scroll down now to get all the other magazine staff on screen at once. And then basically what we've got here are, as it suggests, the different kind of job roles that work at magazine publishers. So we got the editors who kind of provide the quality assurance function, so they're going to be checking accuracy and clarity. So it's not about just purely being stylistic. Obviously that's linking into what we were just talking about, that kind of reputational legal risk. So if there's any inaccurate or misleading content, we know there can be regulatory fines or defamation claims. So the editors are kind of a barrier to prevent that happening. Then we've got the IT support staff, and that possibly is highlighting the importance of kind of publishers' technological dependence, because obviously without stable infrastructure, then obviously digital delivery fails immediately. Then we have the advertising staff, who obviously they are strategically critical because they are a major income stream. So this team is directly driving profitability, and their effectiveness influences revenue mix and margin sustainability. And then we've got also the editor-in-chief. So really, this is kind of centralizing accountability for content quality and compliance, which becomes important later on in video 2 when we're going to be considering governance and regulatory exposure. So although it kind of looks operational, actually it's really about control and environment and revenue generation and concentration of responsibility. Okay, I think that's all pretty much self-explanatory though, so let's go down now to the magazine production process. We can get it on screen, which makes me sadly happy. There we go. Okay, so we can see that in this paragraph we're dealing with the editor-in-chief. So the kind of editor-in-chief determines the content and allocates the writing responsibilities for each edition. So basically we're showing that how authority is concentrated in the editor-in-chief, just like we're speaking about in the previous section. So the editor-in-chief is the person who decides what content appears and whether it's produced internally or outsourced to the freelancers we just mentioned. So they've got strategic control over tone and direction and cost. And this centralization, can be really efficient because it allows clear editorial direction and fast decision making. But it does introduce another form of risk, and that's a kind of key person risk. Because if the editor-in-chief doesn't make good decisions, that they have poor judgment, maybe commercially or ethically, then the consequences affect the entire publication. So although this looks really procedural, it's actually about governance, cost management, and concentration of strategic influence. Okay, then we find out that authors may be producing at their desks in-house, or they may have to venture out of the building to gather material externally, and that really depends on the kind of subject matter, whatever they're working for. So it's not always desk-based, the kind of content production. So maybe they're attending events or conducting interviews or gathering material externally. You've got travel, you've got access fees, time allocation. They're all going to vary depending on the magazine subject. So a sports or film publication could have higher external costs than a home lifestyle title. And it also introduces operational risk here because external events could be cancelled or access restricted. So this is going to reinforce that when we later analyse profitability or cost pressures, the nature of the content matters. Not all of the 300 of Merceh magazines are going to have the same cost structure. Okay, then we move on to this paragraph where we're finding about this kind of the guide that authors have to follow when writing content. So basically there's a defined editorial framework governing what is acceptable and how content is presented, which serves two key purposes. So protecting the brand through consistency and also reducing legal and regulatory exposure through clear guidelines around defamation or misinformation or regulatory breaches. But obviously, kind of the existence of a guide doesn't automatically ensure that there's going to be compliance. So enforcement and monitoring become critical. And then this is exactly the kind of internal control question that could appear in an exam requirement. Not just does the guide exist, but how effectively is it enforced and monitored would be a kind of board level question. Okay, and then we move on to the stage where we're looking at the kind of content schedule, or as they call it in the brackets, the deadline for each magazine. So we know that deadlines are non-negotiable. Content has to be edited, formatted, and printed or digitized in time for release. So this really creates tight coordination between authors and editors and design teams and printing operations. Now, the model is highly schedule dependent. So delays at any stage could disrupt the entire edition cycle. Now, from a financial perspective, missed publication dates could affect advertising commitments and subscription satisfaction, both reputational and contractual risk. Strategically, in a digital-first environment where content can be updated continuously, fixed edition cycles may limit responsiveness. So this is about operational interdependence and time-sensitive revenue execution. And then in these final two paragraphs of magazine, kind of the production process, we find out that content undergoes editorial review before kind of being, just lost my marker again. Here we go, editorial review before being compiled with advertising. There we go. And reader content. And then it's going to be signed off by the editor-in-chief, and then it goes to print or uploaded with its digital copy. So obviously content reviewed by editors reinforces the quality control and risk mitigation, and then being compiled with advertising and reader contributions reminds us really the final product isn't purely editorial. It is a commercial blend of content and revenue generating adverts. Now the editor-in-chief conducts a final review, and that does centralize accountability, as we've already mentioned. So we've got a clear line of responsibility if errors or regulatory breaches do occur. Now, importantly, advertising is integrated before publication, so that highlights the interdependence between editorial production and commercial sales. So if advertising volumes decline, the overall product and revenue mix are going to be affected. So this process is not just operational, it is a control framework linking content, quality, regulatory compliance, and revenue execution. Okay, let's move on then from the production process to software. And I'm not going to go down too far, just so we've got more blank space on screen. Okay, so what do we find out about software? Well, firstly, we find out that publishers, or most publishers, or many publishers, are paying fees to suppliers for software, which helps them publish the content. So that means that operations are dependent on external digital infrastructure. So this is creating recurring operating costs, and obviously is introducing dependency risk. So if a supplier fails or increases prices or limits functionality, then obviously it's the publishers who are going to be facing the disruption. Now there's also a strategic constraint. The capabilities of the software determine what publishers can offer digitally. So design features or multimedia integration or analytics and monetization tools, So although this does appear minor, it's about technology governance, supplier risk, and digital capability. And when we later examine Merceh's specific IT platform, then this is going to give us the foundation for that. Okay, moving on down now to the second paragraph in software. I've got the notes up here for that paragraph. We find out that digital publishing platforms determine design capability, multimedia integration, multimedia distribution, and digital advertising inclusion. So we're finding out that the digital publishing platform, as I lose my marker again, is not just a kind of formatting tool. It actually defines competitive capability. So the functionality of the platform determines whether a publisher can integrate multimedia, distribute across multiple channels, and embed digital advertising effectively. Again, I could just tell I've lost my marker. There we go. Where I'm sure you can see it. Me screwing it around on screen, or thinking, why can't I see it? There we go. So that means platform choice influences user experience. It influences engagement depth and data collection and advertising monetization and speed to market. Now, if the platform is limited, then obviously the publisher is strategically constrained. So digital advertising integration depends on the platform's sophistication. And if the platform does not support targeted or dynamic advertising, revenue potential is reduced. So again, this isn't just an IT infrastructure issue. This is a strategic infrastructure. So again, when we evaluate Merceh's platform in video 2, remember video 3, we have to assess whether it supports modern digital monetization or merely replicates print online. And then we've got the final paragraph in software, where we find out that the kind of digital publishing platforms that are advanced may offer kind of analytics, SEO, as well as integration with e-marketing, and some platforms provide paywalls, which I spoke about briefly earlier on when I spoke about the Times, or the difference between the Times and the Guardian, where you have to kind of pay to access the site online. Now, data analytics really allows publishers to understand their audiences, their readers' behavior, what content is being consumed, how long readers are staying, what's the content that's driving engagement. And that insight helps support targeted advertising and content optimization. So SEO optimization, or search engine optimization, obviously helps influence discoverability. So poor search ranking means declining traffic, and that directly affects advertising revenue and subscriber acquisition. Now, paywalls are central to revenue strategy, determining how much content is free and how much requires payment. Now, when I think about magazines, online publications like The Athletic, which is a sport magazine online, sometimes what they do is they give away articles a month. Now, I support Leeds United, so sometimes I get kind of sent one free article a month in order to attract me. If there's some exciting news, I might have access to like half the article, and they go, hey, if you want to access the rest of the article, you have to pay. So, really, there is a strategy behind the kind of paywall construction. So the design of the paywall is going to help influence conversion rates, it's going to influence churn, it's going to help decide brand positioning. So a basic digital platform is going to limit growth potential, and an advanced one enables data-driven decision-making and scalable revenue generation. And again, when we get to Merceh's specific platform, what we find is genuinely significant for how we assess its digital strategy. So there we go, that is software. And what I've done is put the 3 key takeaways from software at the top of the screen there. So just as a reminder, digital infrastructure is not just operational support, it is strategic capability. The sophistication of the publishing platform determines engagement, advertising effectiveness, data insight, and subscription monetization. And in a declining print environment, digital capability becomes a core competitive differentiator. So again, when we get to Merceh later on, one key question is going to be, is its digital platform enabling transformation or constraining it? And I've just popped that question on the top right hand side for you. Okay, so that is software done. Quite a lot of information drawn out of software. Might be quite an easy paragraph just to have rushed past whilst reading, thinking, well, this seems a little bit insignificant, but I think we've drawn a lot of useful information out of it. Okay, let's scroll down now to see how much sources of income we can get on screen. And it is a fair amount. Okay, so I'm going to talk about the sources of income. I've got all the annotations for the entire section up on screen, a very wonky line to the side there. So basically what's set out in this section is how publishers earn revenue. So it's from print retail sales, print subscriptions, digital subscriptions, and advertising across both formats. So basically it's laying out the revenue architecture. And we can see that it's strategically layered. So retail sales of, there we go, retail sales, I lose my marker again, of print magazines are transactional, so they are vulnerable to declining print demand and changing retail behavior. Now, print subscriptions provide the recurring income that we spoke about earlier on at discounted rates, which improves revenue predictability, but it does reduce per unit margin. Now, digital subscriptions, okay, lost my blooming marker, but it's the third one down. Where have you gone? There we go. Where have you gone? There we go. Oh, so you can see I can't see it. Digital subscriptions, there we go. They represent the kind of future-facing model that's eliminating printing and distribution costs, but it's also competing with abundant free online content. And then the one I kind of pre-marked by mistake is we've got our advertising revenue, which sits across both print and digital formats. And notice the compounding effect here, because declining print readership doesn't just reduce subscription income, it directly reduces advertising revenue too, because advertisers pay on audience reach. So one structural problem creates two revenue headwinds simultaneously. Now, that compounding risk is something that students often miss and examiners consistently reward when it's identified. So the strategic tension is clear. As print declines, digital must grow sufficiently and profitably to replace both subscription and advertising income. So if you see a requirement around revenue sustainability or digital transformation or strategic repositioning, then this is the engine you return to. And I've put a note about the examiner at the bottom of this. So that note is saying that the examiner is explicitly rewards candidates who identify the connections that we've just been talking about, those connections between revenue streams, rather than treating them in isolation. So if you wrote advertising revenue may decline, well, that's going to score 1 mark. Showing that declining readership simultaneously compresses both subscription income and advertising yields, creating this kind of compounding margin pressure, well, that demonstrates the kind of integrated commercial thinking that's going to earn full marks on revenue sustainability questions. Okay, so let's just move down now to our final section, I think, for this video, number 1. Obviously, we've been dealing with the kind of industry as a whole rather than Merceh. That's going to continue in video 2. Then we're really going to focus in on the company itself. But hopefully you're getting a really good understanding of the industry. Now, I can't quite get it all on screen. And I think you know by now that really disappoints me. But there we go. We've got expenses. And the first costs is possibly the one that you would associate most with the magazine trade. And that is, if I can find my marker, there we go, paper costs. And what we see here is that paper costs involve bulk purchasing. I'm just going to highlight the annotation because it's so close to the top of the screen for you to know what we're dealing with here. And long-term supplier agreements, so exposure to commodity price volatility and supplier power. Now, long-term arrangements provide cost predictability, but they reduce flexibility to switch suppliers if prices do rise or perhaps quality declines. Now, there's also a working capital implication. Bulk purchasing ties up cash and inventory, and so it's a classic procurement trade-off, really. Cost certainty versus commercial agility. Okay, then let's go down to our next cost, which is again another one you would associate with the magazine trade, but obviously these two costs are going to start diminishing as it moves more to digital, and that is the printing costs. So publishers have kind of two choices here. They can choose in-house printing, which means kind of higher fixed costs, but they do have control over the quality, scheduling, and content confidentiality. I'm just finding it hard to, there we go, get into the right place. Or they can outsource printing, which obviously offers flexibility, but means having dependence on a third party's capacity and reliability. So we've got a strategic operational choice with direct costs and risk implications. And obviously this has become really relevant, pardon me, when we do examine Merceh's specific approach in the next video. Okay, then we've got print-based magazine distribution costs. Now hopefully you can see the annotation for this nicely on here. Skipped a line there just so we're not covering up the texts. Now, distribution is particularly heavy. So physical logistics such as transport, distribution centers, postage, these create a significant fixed cost burden. Now, as print volumes decline, these costs don't necessarily fall proportionally, because you still need the distribution center infrastructure even if there's fewer magazines being sent. And that is operating leverage risk in action. Now, this is one of the clearest examples of why print decline is a strategic problem, not just a revenue problem, because the cost base doesn't shrink as fast as the revenue. Okay, let's move down now to our next group of costs, and they are, well, the first group is employee salaries. So these employee salaries represent a largely fixed cost base. So we've got editorial, I just highlight some on the screen for you, marketing, IT, administration functions. They have to operate continuously regardless of addition sales volume. Now that creates operational gearing, which means that fixed costs amplify profit movements. So in periods of declining revenue, fixed salary costs compress margins faster than variable costs would. Now, strategically, workforce restructuring is complex and costly, especially where specialist editorial expertise is involved, and that limits the speed at which cost bases can be reduced in response to kind of structural revenue decline. Okay, then freelance author fees. Now these provide the most meaningful variable cost flexibility in an otherwise fixed cost heavy structure. So as we saw earlier, publishers only pay for output produced, and that reduces fixed cost exposure in periods of declining demand. But we should also kind of stress that really high profile freelancers, well, they command premium fees, and then over-reliance on them creates dependency and quality consistency risk. Now, so this means that this variable cost benefit comes with its own sort of strategic trade-offs. Okay, then we can go to technology costs. So this includes, we get it, the digital platform fees, production systems, in administration and accounting. Oh, that's a bad line. And accounting structure. So these technology running costs are increasingly critical, because as the industry digitizes, well, then technology becomes a core cost driver rather than a support function. So a publisher that underinvests in technology to manage short-term costs may find itself competitively constrained in the medium term, because we know that platform capability directly determines digital revenue potential. So technology cost decisions are not just financial. Again, these are strategic choices about future competitive positioning. Okay, then we've got our last set of costs, which are office premise costs. So publishers often require office space, and that happens often across multiple sites. So office premises really kind of reflect legacy infrastructure. So in a digital world with remote working potential, large physical offices may represent structural inefficiency. Multi-site operations add complexity and cost. So with more staff working remotely, the strategic question becomes whether the existing premises footprint is still necessary, or perhaps whether rationalization could release cash and reduce overhead. So when we contrast this with a revenue model, again, the tension is clear. Print revenue is declining, but many print-related costs remain fixed or semi-fixed. So that creates margin pressure over time unless digital growth offsets structural costs. So really this section is fundamentally about operating leverage and structural transition risk. So I've just put up a final mini takeaway focusing on expenses for video number 1. So we can see the significant fixed cost base tied to the print model, paper, printing, distribution and premises. So while some flexibility exists through freelance authors, much of the cost structure is operationally rigid. And that's creating a strategic challenge because print demand declines, cost reductions are lagging behind the revenue decline, that puts pressure on margins. So the entire economic engine of the industry depends on successfully transitioning revenue without being trapped by legacy cost structures. And that's really going to set us up perfectly for analysing Merceh itself in the second half of video 2. But that's in video 2. Now in video 1, we've analysed how the magazine industry in Darland makes and spends money. It's an $8 billion sector. It's moderately concentrated, operating across both print and digital formats, but print is declining, creating long-term structural transition pressure. We've seen that revenue comes from subscriptions, retail sales and advertising, but the cost base remains heavily influenced by print-related logistics and fixed infrastructure. So the fundamental tension is clear. Digital must grow and must grow profitably. So there we go. In video 2, we're going to complete the industry picture, governance, regulations, stakeholders and risk. And then once we've understood that, we're going to move on to Merceh itself. Thank you so much for watching today's video. I hope you found it really useful. If you want to prepare even more, and why wouldn't you, head over to Astranti.com. Over there, we offer a comprehensive suite of resources, starting with a free industry analysis and a detailed pre-scene analysis where we break down the case study for you. We also provide a strategic analysis using relevant models and a top 10 issues analysis to highlight the most likely challenges you're going to face in the exam. And to help you revise, to help you practice, we offer 2 pre-scene based mock exams plus an exam technique mini course, as well as our live and recorded masterclasses to make sure you are fully prepared for your exams. Thank you so much.